So especially with the second quarter earnings just released, there is a ton of shocking stuff happening to WISH stock right now, making it drop an insane 20% the last trading day. And this happened despite gaining 65% almost right after going public, and the recent 77% run up to over $14, making WISH drastically fall all the way down to $7.55. So with this might literally being the craziest video we've done on the company so far, what we are going to do today is give you an insight into what actually happened in the new earnings report that makes the stock drop such massive amounts, as well as break down exactly whether it is still a good buy at the end. And as the analysis in the video is absolutely crucial to consider before buying the stock, make sure to stay tuned. But before we jump right in, just hit that subscribe button down below. And as we'll keep you updated on breaking news and awesome trading opportunities every single day, subscribing would not only help us but also you. So there is really no excuse for not smashing the subscribe button, it's free, and you can always unsubscribe if you feel so. Alright, so let's start with the definitely craziest thing we have to talk about today, which of course is the just shocking earnings report for the second quarter. And although they actually had a pretty strong start, there are a few crucial aspects that substantially lowered the expected financials and made WISH end up with an astonishing $111 million net loss as stated in the report. So starting off with revenue, we saw a 6% year-over-year decline, now sitting at just $656 million. And although we for example had some huge 126% increases in the logistics revenue which is sitting at a whopping $228 million, those numbers got drastically offset by, say, the report of an almost 30% decline in marketplace revenue, now at just $378 million. But even the mentioned gains in the logistics sector didn't really do the intended trick for the company. WISH for example expected its better logistics to also increase customer retention, WISH actually ended up declining as well. But here is where they get more in-depth into one of the mentioned crucial aspects you need to keep in mind here with this earnings release. So whenever you get financials reported from a company, you usually use the same quarter of last year as a comparison to identify the year-over-year growth. If, like it was in WISH's case, the company however experienced some just insane growth in the last year, everything that's lower next year may seem terrible at first, but might still be higher than 2 years ago. So now that all the staying-at-home purchases are decreasing on the WISH platform, revenue, as well as app installs, are also massively declining compared to last year. But there are a few other super important metrics that just don't look as good in the second quarter as before. While for example engagement was also lower compared to last year, the costs of digital advertisements actually went up way more than intended, despite being the literally only source for the company to drive demand and conversions on the app. And combined with more advertisers starting to target Android devices more and more, which is mainly due to the recent iOS privacy changes, the ton of competition drive the price higher for a limited supply of impressions as said in the report. But those higher costs are a huge problem for WISH, especially as most of their products operate on just a very small profit margin, often costing only a few dollars or even cents. But those now lower prices of WISH's stock don't necessarily have to be a bad sign, especially considering the biggest reason for a lot of spikes on the stock, some massive hype from retail traders. And because of the also noticeable higher short interest, the stock literally has some awesome short squeeze conditions again. As a result, the number of mentions on forums like Wall Street Bets has once more increased by some insane percentages in the last days, with thousands of people ready to drive the price back up again. But this time we can't really talk about the upcoming prospects on the stock due to the company literally saying that they just won't do an outlook because of focusing on different things. Nevertheless, they actually did mention that some further revenue declines are possible. However, the short interest is the most important factor that allowed WISH stock to gap up massively before. So whether you should buy strongly depends on whether Wall Street Bets and retail investors continue to hype up the stock. And as the hype certainly continues, while also getting steadily higher short interest data, it certainly looks good in terms of a successful meme stock. Alright, if you like this video and want to support our mission of providing free financial information here on YouTube, please ensure you're subscribed and definitely consider leaving a like. Thanks a lot and see you next time.